Hi, I'm Nathan Thornberry, and if you're like me, you are an amateur investor in the stock market, which has been anything but predictable for the last month or two. And it's hard not to look at 1,000 point drops. The headlines that hit your computer screen and your cell phone of the worst day since 2020, and these sorts of things. It's a lot of noise. It gets people to click, and it's newsworthy, I suppose, to an extent. But there's a little bit of fear mongering there that isn't very realistic, and I want to tell you why. So, the idea, if you believe some of the more bearish columns out there, is that, this market's going to get horrible, and all of this is bad stuff's going to happen. The market hasn't bottomed out; it's going to go down, and then they start predicting the number. It's it's going to go down another 15%, and of course, yesterday, some of those fears seem to come true for people, right? Because maybe they were pretty invested in that, in that big Target retail store, and they lost 25% of whatever money they had in it. Now, on that same day, there were people like myself, and hopefully you, who had a little bit of cash sitting on the sidelines that were waiting for the crazy shit to happen and, ready to pounce. Is it a perfect science doing that? Can you always pick the bottom? Absolutely not. And, I think I lost an extra 5% on that the next day. But my basis in Target stock, as an example, is 25% lower than typical investor as of 3 days ago. And all because their CEO said the word inflation. That's all it took. That's all it took, because this market's a bit of a powder keg. Here's what you ought to know about the Target thing, is that they actually beat estimates as far as revenue goes. So people are shopping, people are buying. The earnings, the profitability of the company, that took a hit, and it's taken a hit because of a number of factors, particularly this inflation, and other factors like supply chain and keeping products on shelves, and having to work way too hard to get stuff done, which is a big problem in this economy. And this all leads to short-term losses that appear very, very scary. And then you go to the internet and you look for economic news, and sure enough, on a bad day, there's nothing but bad economic news. Big surprise. Here's why the doom and gloomers out there are very likely wrong. I mean, there's always a possibility of Armageddon, and there was a possibility of Armageddon 5 days ago, and 5 months ago, and 5 years ago. On any given day, including tomorrow, we could have something happen in the market that turns it up on its head. Another war breaks out, for instance. That would be the kind of stuff that can change the market in a real way. We could have a bank collapse, or something along those lines. Okay, well, short of that, are you at risk as an investor of all of this doom and gloom that is otherwise available and at your fingertips? And the answer is no. And here's a few reasons why. Number one is, the Fed, which has raised rates recently and is kind of being blamed for, and hard not to blame them for some of the market conditions. They're limiting capital access. They're making it so that it's more expensive to borrow, which is a strangulation of a lot of tech companies, particularly. And not to mention, it sucks for people that are out there buying something, whether it be a car or a house or anything else. Those interest rates are going up. Things are becoming less affordable. Now, that has an effect on the market, and it goes down, but it won't go down that much, because if you listen to them on what they're looking for at the Fed for a reversal of this course to, plateau interest rates or even reduce them. It's to show that inflation has been calmed, and demonstrably so. Well, if the market is going down, in a substantial way, and not just, scare you, poop yourself a little 1,000 or 1,200 point loss of a day, but, something more substantial, 20% of the market, 25% of the market, something that, causes companies to topple over, right? like that is well beyond the point at which the Fed will see reasons, even if they don't really see the inflationary control measures working, in a direct way. They would be hard pressed to leave the market hanging and let it go, into a death spiral without doing something. And we've seen this. This is the modern way of our government dealing with these things, because government is really, if you're pure capitalist and libertarian, you don't think they should be involved at all. But if we're going to have a controlled market, well, it has to control in both ways. It can't just regulate and limit what companies and private entities can do, as they do with regulations and lending as a prime example. It also has to regulate on the other side and keep companies from failing. And so the government has volunteered to take that role over the last couple of decades, and more so every single year. Too big to fail. Man, that phrase was invented, just a few years ago. I think probably 2008. And, this is real. Too big to fail exists. And so the whole market, by the way, qualifies as too big to fail. It's not something that's unique to banks. If the market is failing, it's too big to fail. They won't let it, and they'll change the rates. So, the doom and gloom tied to the rates is nonsense, and nobody would do it, and no one would allow it to happen, and there would be an uproar from citizens, voters, etc., if lawmakers didn't do something about it in that crazy scenario. That's not going to happen. Second reason it's not going to tumble and be doom and gloom is that you have a bunch of people that have entered the market as investors, and you have institutional investors too, that don't like to look stupid, don't like to feel stupid, and don't like to buy something for $100 and sell it the next day for $50. That doesn't feel good. There's an ego hit for that. So, as a stock goes down, and you don't have to see this on a horrible day, you can see this on any day. As a stock starts to go down, there's people that, see an opportunity in it. When Target went down 25%, I put a substantial amount of money in Target. It's like, wow, I'm getting a great deal today, or at least it feels like it, but it wasn't going to go any lower than that. Why? Like even in, this Armageddon on Target, why does it stop at 25%? Well, one, you have people like me buying, hopefully people like you too. And two, you have people that paid 25% more that are not in the mood to sell today, right? They're not going to take the loss. They don't want to take the loss. So, what do? They hold on to it. And this is another feature of our stock market that keeps it from going crazy like this. It's that, people that own stocks are generally well off in relatively speaking. And so they don't have to make a move on the same day. They don't have to sell the day. They can hold out. And that keeps the market from going into a death spiral as well. And here's the third reason, and this is a big one. There's always good news in this market. You know, the world economy and the U.S. economy are so diversified now that there's always some piece of good news to cling on to. And, you know, economic activity and, you know, people living their lives and, you know, buying soap and, you know, being humans, that doesn't stop. So remember all of those things, and we'll see you next time right here. Don't freak out. Don't sell all your shit.